All right, Talk Tickers listeners, ready for another deep dive. Today we're taking a look at Wendy's Q4 2024 earnings call.
They just wrapped up their fiscal year.
Yeah, and there's a lot to unpack.
A lot to unpack indeed. Quite a noteworthy performance this quarter and really throughout the whole year.
Yeah, noteworthy is one way to put it. Some serious global growth, system-wide sales up over 5%.
Over 5%.
And same restaurant sales, even better, jumped over 4%.
You know, it's especially interesting to me that their U.S. performance actually beat out the entire QSR burger category.
So they weren't just riding some industry wave, they were taking names and grabbing market share.
Absolutely.
All right, so we know they're winning, but how? They did have a few clever tricks up their sleeve, like their partnership with a certain absorbent yellow friend.
Ah, yes, the SpongeBob SquarePants collaboration.
For his 25th anniversary.
25 years, can you believe it? I think that was a stroke of genius, honestly.
Yeah.
Peaked at a 20% boost in same restaurant sales.
Talk about a marketing home run. It really seems like everyone, young and old, loves that goofy sponge.
They do.
But Wendy's didn't just rely on that nautical nostalgia. They kept things fresh, too, with new menu items.
For sure. For sure. They introduced limited time offerings like the salted caramel frosty and mushroom bacon cheeseburger.
Oh, the mushroom bacon cheeseburger.
And of course, their breakfast menu, which has always been a bright spot for them, continued its solid growth, up over 4% year over year.
So they're keeping things interesting for customers, which is key in this world. But, here's where it gets really interesting. Their digital strategy is on fire.
Absolutely. Yeah, their digital mix jumped 130 basis points, reached 19% globally.
So almost 1 out of every 5 Wendy's orders is now online.
It's a huge shift.
I guess those late-night drive-through runs are slowly becoming a thing of the past.
Maybe.
And that translates into some serious numbers. Digital sales grew almost 40% year over year.
Yeah, and their loyalty program is booming too, over 46 million members now. That's a massive pool of customers they can directly connect with.
It's like they're not just flipping burgers anymore, they're building a digital empire.
Yeah.
But hold on, their story doesn't end at the U.S. border.
No, they're making waves internationally too. Opened 113 new restaurants globally just in Q4 and saw a very impressive 11% system-wide sales growth on a constant currency basis.
So they're planting their square burger flag all over the globe. But it's not just blind expansion.
Oh, no, they're being strategic about it. They've also been strategically closing down some underperforming restaurants.
Like pruning a tree to let the healthy branches flourish.
Exactly.
Smart about where they invest their resources.
Yeah.
Really focusing on maximizing profitability. So now let's zoom out a bit and look at the full year highlights for 2024.
Absolutely. It was a banner year for Wendy's.
I bet.
A whopping $14.5 billion in total system-wide sales.
That's a lot of Frosties.
A lot of Frosties, yeah. And, breakfast sales continued to outperform the QSR burger category, growing over 6% for the full year.
And we can't forget their commitment to innovation.
Oh, no, definitely not.
From expanding their chicken offerings with those saucy nugs to experimenting with seasonal Frosty flavors,
Yeah.
they kept things exciting for customers.
Absolutely. Always keeping things fresh.
Yeah, they definitely know how to keep people coming back for more. But beyond the food itself, they've also been investing heavily in technology.
That's right. A key part of their strategy. They've upgraded their mobile app, rolled out digital menu boards in tons of locations. They even started using AI for voice ordering in select stores.
Talk about a tech makeover.
Yeah.
And they're not stopping there. They went through some big changes in 2024, brought in a whole new leadership team.
A new team, new vision. And this new team seems to be hitting the ground running.
I think so, yeah.
They're laser focused on what they call operational intensity.
Which basically means?
They're obsessed with delivering an exceptional customer experience.
It sounds like they're raising the bar, both for themselves and the whole industry.
I think so, yeah.
But all these initiatives require fuel. So they've also made some changes to their capital allocation policy.
They're definitely shifting their focus, putting more resources towards development, technology, and strategic share buybacks.
So they're making sure they have the financial firepower to execute on their ambitious plans.
That's right.
Now, looking ahead to 2025, what's their outlook?
Well, continued growth is definitely the aim. They're focusing on craveable core items, impactful innovation, value offerings, and of course, global unit development.
So more of what's been working, but amplified.
I think that's a good way to put it, yeah.
They're expecting system-wide sales to grow 2 to 3%, and net new unit growth in the same range.
Yep, that's right.
They're also keenly aware of the potential challenges ahead, like the possibility of tighter consumer spending in 2025.
Oh, for sure. I mean, no one has a crystal ball.
Right. So they're not just blindly optimistic, they're realistic about the economic environment.
Yeah, exactly.
But they're confident in their ability to adapt and win, even if things get a little bumpy.
They've got that scrappy underdog spirit, ready to fight for every customer and every burger sale.
Okay, so they're growing, they're innovating, they're investing, and they're cautiously optimistic about the future. But what does all this mean for investors?
Well, that's a million-dollar question, isn't it? To really understand that, we need to dive deeper into their financials.
All right, Talk Tickers listeners, get ready for part 2, where we'll break down Wendy's Q4 results in detail. We'll be back right after this.
All right, so let's dive into the numbers, see what kind of feast Wendy's is serving up for investors here.
Let's do it.
Their global system-wide sales reached a tasty $3.7 billion in Q4.
Okay.
This was fueled by a 4.1% increase in same-restaurant sales in the U.S. and an even stronger 4.9% jump internationally.
So their growth engine is firing on all cylinders. But what's driving this growth spurt?
Well, in the U.S., it's a combination of factors. More people walking through their doors, for one. And those customers are spending a bit more per visit. They saw growth across all day parts. So breakfast, lunch, dinner, even those late-night cravings.
So they're not just a lunch or dinner spot anymore. It's becoming a real all-day destination.
Yeah.
But how much of this is just the SpongeBob effect?
Well, SpongeBob certainly played a part, especially in October, when the promotion was at its peak.
Yeah.
But even after SpongeBob sailed away, their same restaurant sales for the last 2 months of the quarter were still right in line with the rest of the industry.
So it wasn't just a one-hit wonder. They're seeing some real consistent growth, even without the cartoon superstar.
Right.
Now let's talk money, specifically their revenue.
Okay. Their U.S. company-operated restaurant revenue saw a respectable 2.7% increase year over year, reaching $232.8 million. And their franchise revenue also jumped, with franchise royalty revenue up $6 million year over year to $133.8 million.
So it's a win-win. Both Wendy's and their franchisees are seeing those cash registers ring.
Yeah, happy franchisees usually translate into a strong and growing brand.
Everyone's happy. That's a good sign.
Absolutely. Now let's shift our focus to margins.
Okay.
This is where the real profitability story unfolds.
All right, let's see how efficiently they're turning those burgers and Frosties into profits.
Well, their U.S. company restaurant margin was a healthy 16.5% in Q4, a significant jump compared to the prior year.
How significant are we talking?
We're talking a 300 basis point increase. That's a massive leap in profitability.
Wow, that's impressive. How did they manage to squeeze out that much extra profit?
A combination of factors. First, they benefited from higher average checks, customer count growth, which gave them what we call sales leverage.
Okay, so more sales with relatively fixed costs equals higher profit margins.
Exactly. But they also implemented some smart productivity initiatives that help streamline their operations and reduce costs.
So they're working smarter, not harder.
Indeed. It's all about finding ways to do more with less. Now, let's take a look at their G&A expenses and adjusted EBITDA.
Okay.
These are really important metrics for understanding their overall profitability.
Break it down for us.
Sure. So there's G&A expense, which includes things like salaries, administrative costs. That was $67.2 million in Q4. And their adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, that increased 8.6% to $137.5 million.
So even with some increased expenses, their profitability is still on the rise.
Yeah, they're managing their costs effectively while also making strategic investments for growth. It's a delicate balancing act.
It is. Now let's talk about the real moneymaker, cash flow. How much cold, hard cash did they generate in 2024?
Well, on a full-year basis, they raked in $355.3 million in cash from operations.
Wow.
After investing $94.4 million in capital expenditures, which includes things like building new restaurants, upgrading existing ones, their free cash flow reached a very healthy $279 million.
Okay, so they're generating a decent amount of cash, but the real question is, what are they doing with it?
Well, they're not letting it just sit in a bank account. They're investing back into the business, allocating $53.4 million to accelerate their digital strategy and $24.9 million to develop new company-owned restaurants.
So they're putting their money where their mouth is, literally, fueling that growth engine that's been driving their success.
Exactly. And they're also investing in their build-to-suit program.
Right.
Which is a really smart way to accelerate new restaurant development.
Remind me, how does that work again?
Sure. It's essentially a partnership between Wendy's and its franchisees. The company co-invests in new restaurants with franchisees, providing them with financial support to get those locations up and running.
And in return, Wendy's gets a higher cut of the profits.
Precisely. It's a win-win situation. It's a proven strategy for accelerating unit growth, expanding their footprint.
Now let's talk about how they're rewarding their shareholders. Are they sharing the wealth through dividends and share buybacks?
Absolutely. They announced a first quarter dividend payment of $0.25 per share. However, their new target dividend payout ratio is 50 to 60% of adjusted earnings, which means they're slightly dialing back their dividend payments,
Okay.
just to free up more cash for those growth investments we talked about.
So they're prioritizing growth over immediate shareholder payouts, but still committed to rewarding their investors.
Right. Beginning in the second quarter, they expect to pay a quarterly dividend of 14 cents per share. And for the full year 2025, they're projecting a total dividend payout of $0.67 per share.
So a slight reduction, but they're still sharing the profits with their loyal shareholders. Now, what about share buybacks?
Actively repurchasing shares as well. Through the end of fiscal year 2024, they repurchased approximately 4.3 million shares and had approximately $235 million remaining on their $500 million share repurchase authorization.
So they're putting their money where their mouth is, buying back their own stock. They believe it's undervalued. That's a sign of confidence in their future prospects.
Indeed. And they ended the year with a strong unrestricted cash and cash equivalents balance of $451 million and net debt of approximately $2.3 billion.
So they're in a solid financial position to continue executing on those growth plans.
Absolutely. But wait, there's more?
Of course there is.
We haven't even touched upon their updated capital allocation policies.
Okay, now things are getting interesting.
Right. This is basically their financial playbook for the future.
All right, Talk Tickers listeners, get ready for part 3, where we break down Wendy's capital allocation strategy.
All right, Talk Tickers listeners, welcome back to our deep dive into Wendy's Q4 2024 earnings call. We've covered their impressive performance, and now it's time to break down their updated capital allocation policy. Think of this as their financial roadmap for the future.
It is, yeah. This policy outlines how they plan to invest their hard-earned cash to achieve these ambitious goals.
Right.
And their top priority, investing in the business itself.
So they're doubling down on what's been working, but how exactly are they planning to deploy those dollars? Okay, so they're planning to significantly increase capital expenditures in 2025 to between $100 million and $110 million. A big chunk of that's going to go towards building new restaurants globally. They're also investing in technology upgrades for existing restaurants, like those digital menu boards, the kiosks we talked about earlier.
So they're not just expanding their footprint, but they're making their existing restaurants more efficient and tech-savvy, too. It's a two-pronged approach to growth.
Yeah, exactly. And they're not forgetting about their build-to-suit program either, planning to invest around $70 million in this program in 2025.
So they're continuing to incentivize franchisees to open more locations. It's a smart way to accelerate growth without taking on all the risk themselves.
Yeah, absolutely. A proven strategy for expanding their footprint strategically.
Now, let's talk about how they plan to reward their shareholders. Because, at the end of the day, investors care about one thing, returns. So how is Wendy's planning to put money back in their pockets?
They're committed to paying an attractive dividend, but they have made a slight adjustment to their approach. They announced a first quarter dividend payment of $0.25 per share, but their new target dividend payout ratio is 50 to 60% of adjusted earnings.
Okay, so they're reducing those dividend payments just a little bit to free up more cash for those growth investments.
Yeah. It's a trade-off, but one that could really benefit shareholders in the long run.
Right.
Beginning in the second quarter, they expect to pay a quarterly dividend of $0.14 per share. And for the full year 2025, they're projecting a total dividend payout of 67 cents per share.
So a slight reduction, but they're still committed to rewarding their shareholders. What about share buybacks?
Oh yeah, they're planning to ramp those up in 2025, allocating up to $200 million for this purpose.
Wow.
And they're planning to execute most of those buybacks in the next few months.
Okay, that's a big commitment. It's a clear signal that they believe their stock is undervalued right now.
It is. A bold move suggests they're pretty confident in their future prospects.
Right. Now, beyond investing in growth and rewarding shareholders, they're also committed to maintaining a strong balance sheet.
Of course, always a good idea, especially in uncertain economic times. Nobody wants to see a company drowning in debt.
Exactly.
They've established a target net leverage ratio of 3.5 to 5 times adjusted EBITDA.
Which means,
They're aiming to keep their debt levels at a manageable level, relative to their earnings.
so they're not going on a debt-fueled spending spree. They're being financially responsible.
Precisely. It's all about striking that balance between investing for growth and maintaining a healthy financial position. Now, taking all these factors into account, they expect to return up to $325 million of cash to shareholders in 2025.
That's a big jump compared to 2024.
Yeah, through a combination of dividends and share repurchases.
They're putting their money where their mouth is when it comes to maximizing shareholder value.
They are. Their capital allocation plan reflects a well-thought-out strategy that really balances those growth investments with shareholder returns. Now let's shift gears, talk about their financial outlook for 2025.
Okay, so they've laid out their plan, but what do they expect to achieve? Smooth sailing or choppy waters ahead?
Well, they're taking a realistic approach to their guidance, not sugarcoating the potential challenges,
Okay.
but not letting fear paralyze them either.
A healthy dose of cautious optimism. I like it.
I do too. They've considered various economic forecasts, and those forecasts indicate that consumer spending for food away from home is expected to remain under pressure in 2025.
So they're acknowledging those headwinds. But they're not throwing in the towel.
No, not at all. They're also anticipating that traffic in the QSR burger category could be flat or even down slightly compared to last year.
So increased competition and potentially weaker consumer spending. Some serious challenges.
Yes, but they're confident in their ability to adapt and outperform the market, even in a tough environment.
They've got that fighting spirit. So what are their specific projections for 2025?
Okay, so they anticipate global system-wide sales growth of approximately 2% to 3%.
Okay.
This growth will be driven by a combination of same-restaurant sales and new unit growth.
So still expecting to grow, but maybe at a slightly slower pace than previous years.
Yeah, it's a measured outlook that takes into account those potential economic headwinds.
Right.
And it's worth noting their system-wide sales growth rate in 2025 will be slightly impacted by their decision to close underperforming restaurants in the fourth quarter.
Right. That move will create a little drag on their sales growth in the short term. But ultimately, it's a strategic decision that will strengthen their overall footprint.
Right. Short-term sacrifice for long-term gain. Now, let's talk about their net new unit growth projections.
Okay, how many new Wendy's can we expect to see popping up around the world in 2025?
They're projecting global net new unit growth to be between 2 and 3%. This represents their highest net unit growth rate in over 15 years.
Wow, that's pretty impressive, not letting the current economic climate slow them down.
No, they're seeing this as an opportunity to capitalize on favorable real estate conditions, expand their presence in key markets.
Yeah.
Now, let's move on to margins.
Okay, what are they projecting for their U.S. company-operated restaurant margin in 2025?
Expecting a margin of around 16% plus or minus 50 basis points.
So roughly in line with their Q4 2024 performance. Not bad at all.
Not bad. They're confident they can maintain these healthy margins even with those potential cost pressures. This confidence stems from their planned productivity initiatives.
Right.
And their expectation of continued sales growth leverage.
So they're planning to work smarter and sell more. A winning combination. Now, what about their G&A expenses?
They're anticipating an increase in G&A expenses to between $285 million and $290 million in 2025.
Whoa, okay, that's a significant jump. What's driving that?
A big part of it is due to their decision to redeploy company breakfast advertising spend to investments in field operations.
So they're shifting their focus from marketing to operational excellence. They're really serious about improving the customer experience.
Exactly. They believe that investing in their field organization will lead to a better customer experience, which will ultimately drive stronger sales growth in the long run.
It's a long-term play. Now, what about their adjusted EBITDA?
Okay, so they're projecting adjusted EBITDA to increase to between $550 million and $560 million in 2025.
So despite the potential headwinds, the increased expenses, they're still projecting some pretty healthy profit growth.
Yeah, it's a testament to their strong financial management and their focus on those initiatives that drive profitability. Now, let's talk interest expense.
Okay, how much are those debt payments going to eat into their earnings?
They're anticipating interest expense of approximately $127 million in 2025.
Wow, that's a big number. What's driving that increase?
They're planning to refinance $400 million of debt maturing in 2025 and 2026.
So they're being proactive about managing their debt. Smart move, especially with interest rates going up.
It is. Now, taking all these factors into account, they're projecting adjusted earnings per share to range from $0.98 to $1.02 in 2025.
So even with those potential headwinds, they're still expecting to deliver some solid earnings growth. Good news for investors.
It reflects their confidence in their ability to execute on their plans and navigate those challenges. Now, let's talk cash flow.
Okay, how much cash do they expect to generate in 2025?
They're projecting free cash flow to be between $275 million and $285 million.
So another year of healthy cash generation.
It is. This strong cash flow is going to be driven by earnings growth, partially offset by their increased capital expenditures.
Makes sense. Investing for the future, which will ultimately drive even stronger cash flow down the road.
Right, it's a virtuous cycle. Now let's recap their key financial projections for 2025.
Okay, give us the highlights.
Okay, so they're projecting global system-wide sales growth of 2% to 3%, net new unit growth in the same range, a U.S. company-operated restaurant margin of around 16%, adjusted EBITDA growth to between $550 million and $560 million, and adjusted earnings per share of 98 cents to $1.02. They're also expecting free cash flow to be between $275 million and $285 million.
So those are the numbers, but what does it all mean?
Well, I think it means that Wendy's is a well-managed company, solid track record of success.
Yeah.
They're making those strategic investments to drive growth and profitability both in the U.S. and internationally, and they're committed to returning value to shareholders through dividends and share buybacks.
They're firing on all cylinders.
They are.
Now, before we wrap up this deep dive, let's have a little fun with our This Is Not Financial Advice segment.
Oh, yes. Always enjoy these speculative tangents.
All right, picture this. Wendy's, building on their recent success with nostalgic partnerships, they decide to team up with another iconic brand from our childhoods.
Intriguing. I'm all ears.
They're partnering with, wait for it, Nintendo.
Oh, wow. Bold move. I like it. But how would that partnership actually work?
Okay, they launch a limited edition Super Mario meal
Okay.
featuring a spicy chicken sandwich, but get this, it's shaped like Mario's iconic mushroom.
Brilliant. Kids would go crazy for that.
Right. And to sweeten the deal, the meal comes with a special edition Wendy's Frosty Cup featuring Mario Kart characters.
Now, that's a collector's item I would be willing to shell out some coins for.
Right. It's a win-win for both brands. Wendy's gets a huge marketing boost, Nintendo gets to tap into a new generation of fans, and who knows, maybe this partnership could even lead to some exciting new menu innovations.
The possibilities are endless.
Inspired by classic Nintendo games.
Yeah,
But remember, Talk Tickers listeners, this is all purely hypothetical.
of course.
This is not financial advice, folks. But it's always fun to speculate about the future.
It is.
Wendy's is clearly a company that's not afraid to innovate and push boundaries. They're a company worth watching.
For sure.
And that wraps up our deep dive into Wendy's Q4 2024 earnings call. Thanks for joining us, Stock Tickers listeners.
Until next time, happy investing.